Yeah, fingers crossed.
Hello, everybody. It is already time for OPEX Tuesday with my buddy Imran. How are you doing, Imran?
Hey, Brent, good to see you, man. This time
We
again.
it's it ages me because it's like I can't believe it already. That pops up on my calendar. I'm like, holy cow! Another month has gone by,
Yeah.
which is always amazing. So if I believe we're simulcasting on Twitter and YouTube right now. If by chance, just to make sure y'all can hear us, put something in the chat would be helpful. And we will be recording this and putting this recording up as well for everyone to see. What we started talking about today, not to just sort of jump right into it, but you and I just started chatting before, using up all the good points. There we go. Gunter's up there. This stuff always amazes me. This is the E-minis. This is the December contract. This is 828, right? We traded at 41.64. 2 minutes before that print comes out, we give a little knee jerk to 41.74. And I've seen 100-point declines pretty fast before, but I think this may be the fastest 100-point decline I've ever seen. I don't know how you feel about that, but it was the volatility is really something else.
Yeah, I mean, the thing is, it was such an important number, right? It's become, you know, CPI has become more important than anything else because it's such a big feed into the Fed reaction function, right? So that's what anyone cares about, like how much they're going to put rates up, when they're going to stop, all this stuff. So there was obviously a lot of algos there that were ready to pounce if that number came in hot, right?
Yeah.
Um, so yeah, that seems to be what happened, right? And the algos react a lot quicker than we do.
I mean, that is for sure the case. And the thing, we were just talking about before too was, I sort of understood the move up into even 4,100 in a way. And it seems like there's an echo. People are saying, is that just for Allen or is everyone getting me twice? It seemed like in a way the extra move overnight, right, just kind of just didn't make a whole lot of sense. I mean, why would you rally so hard into that number that had so much riding on it? These are, enigmas wrapped in whatever that saying is. It's
But
an
I think
enigma.
I think it must be. You're totally right. Like you wouldn't rally the market, you wouldn't take the market higher if you're a discretionary actor, right?
Yeah.
But there's been a lot of talk about CTAs getting top and tailed by this market, right? So um, apparently CTAs had a bit of a buy level where they're
Yep.
going to be back in above 41.07 or something on S&P, and that broke yesterday, right? So
Right.
I think maybe part of that is just programmatic being forced back into the market above a certain level. That took us to the local high before the number, and then the number comes out, and then loads of fresh selling comes in, algos, discretionary people whoever else, and yeah, those CTAs unfortunately got top and tailed again. By the looks of it, right?
Yeah. Now, what we put in our note this morning was basically that, and I'd like to get your opinion on this. The most of the put position that was riding, and this is the index, so this is S&P and the Nasdaq complex, was essentially had a big put position coming in late last week, and a lot of you follow me have already heard this sort of spiel, but we flipped to basically a call weighted position, meaning that call deltas, if you just measure them on aggregate yesterday, were larger than the put deltas, and that was really just this signal that any long put positions just got absolutely destroyed. Even if you're short puts, like the few of those are just going to burn out, right? When vol gets crushed and the market rallies, 5+% in a matter of a couple of days. But a lot of those puts did not get closed, right? A lot of funds will hold those until expiration, for better or for worse. And so while at 4,100, those puts are not worth anything. If you sort of like spark something, there's a lot of jump risk embedded in there, right? You're going to get suddenly those puts are going to wake up, right? They're going to gain value very quickly. You get vol spiking, plus you get the delta drop, right? And then suddenly a 4,000 put, and I'm going to look at the value here in a second, but the value of a 4,000 put that expired Friday probably went from, a couple bucks all the way up to, 50, 60, 70 bucks, right? In the matter of a few seconds. And so that's sort of the jump risk that this number invokes. And now we kind of have a little bit more put position for the market, but we're going to funnel into the Fed, which is now arguably that much more important, right? Whereas there wasn't a huge vol premium for next Wednesday's FOMC, but now that's probably going to hold a stronger premium. So
I'm not sure. not sure that's true, right? Because
Oh, all right.
the reason, because I was talking to my guys about this today, and I was like,
Yeah.
that number was so hot that 75 bips is nailed on now. It's not,
Right.
there's no like uncertainty right now. They're starting to price a small probability of 100 bips next week, which I think's unrealistic, right?
Mm-hmm.
But you never know, right? If the Wall Street Journal guy that they always leak it to comes out and says it, it's going to be 100 bips, right? But
Right.
the point is that you've gone from pricing in a couple of weeks ago 70, 80% probability to it's a done deal that it's 75 bips now with that hot inflation print. So for me, that takes that part of the uncertainty of the FOMC away. It does add, there is some new uncertainty in terms of, well, what are they going to guide about future meetings, right? And what is it going to look like in November or December or whatever? Where's the terminal rate? Is that going to be revised much higher? So those are the kind of new pieces of news that we'll get in FOMC. But the actual hike that they deliver is now pretty much as certain as it's been, right? It has to be 75 bips, right? So I wonder whether or not the market does it's had such a big knee jerk down here. If it can stabilize around 4,000 and then they deliver the 75 bips that is priced in, kind of, why does it need to move that much? I'm not so sure.
Yeah, and I think you do bring in some excellent points there. And sorry, I have a little bit of computer slowness over here, so you're seeing all my my sheets get closed up. But I think that what you bring up are good points, right? And the question is going to become: do you sort of end up in a situation where I'll just take the screen share off for a minute. But do you end up in the situation where the Fed expectations maybe I think everyone just continually thinking, one more and then done, one more and then done, or just, we're almost done. We're almost out of this, right? And the expectations keep changing. And for me, that's sort of the uncertainty. And I know they're going to change, the way they're guiding and different things like that. But, I don't see any reason for anyone to get materially short volatility here, right? Do you want to be short puts into end of month if you're certainly less comfortable doing that today than you were yesterday, I think.
Oh, for sure. But it's more a question of, see, I'm not convinced that the street is after this Friday expiry. I think the street has got this monster 4005 strike that they're long in about 18 billion notional last time I checked, right? The JP Morgan trade. So are they short enough puts against that to make them short vol, or is the street long vol? Because the last time we went down to 3,900 a few weeks back, or was it even a few weeks back? It was like a week ago. I think we were down at 3,900.
Yep.
The volatility was not. They weren't reaching for it, right? Like
that is correct. Yeah.
The fixed strike options were getting offered, so the VIX was underperforming the move that you should have expected to see, and the price actually in options land was showing you that the street actually isn't reaching for vol. They might not be that short. If anything, this 4,000 strike is very much in play. And I would argue that any shorts that the street does have maybe are this Friday expiry, which is obviously creating a bit of short gamma on the way down here, which has exacerbated today's move. But as those decay away between now and Friday, the street is then left with this monster long position on the 30th of September strike. And if the FOMC doesn't jolt us another 100 points either way, then you could have a situation where they're choking on their long vol positions, right? And like similar to pinning effects that we've seen before, do we see that again into the end of September? That's kind of what's on my radar, and I think that's a realistic scenario still, right?
Yeah, and I mean, so in theory, right, they're short this 4,005 strike call. Well, they're not in theory; they are short this 4,005 strike call. But you also have just a tremendous. This is total gamma here. So this is that from a gamma perspective. This is that 4,005 strike call right here, and this is the rest of the positions at 4,000, right? So these are all puts down here and calls up here. So I do see and I do agree with that view that position comes into play. Now, the long put position, right, that dealers would essentially be short would be this one down here. That's the 3580. So, I think I do think if we break under 4,005, that, we still have another 2 weeks really, at least for that 4,005 call to expire. And who's to say how that's exactly going to play in. But I do think we had this conversation, I believe, in March, right, where does that JP Morgan long strike, right, that dealers are then, the short strike that they're long, which is way down at 30-20, is that sort of adding to volatility the street can offer, and that helps to basically be a source of volatility supply to help quell these rallies. But back to your original sort of point about this is that we've not seen, there's still not this grab for volatility, even today, right? Once we broke through 4,000, kind of to your point, just like we were breaking through 3,900, testing 3,900 last week, and it's failed this whole year, that extra grab, right? You finally go, okay, this is going to be the spillover, the sort of downdraft move that we've all sort of kind of been keeping our eye out for. It just doesn't ever really seem to materialize, right?
Yeah, exactly, right. And I mean, I can rationalize it. That makes more sense when the street already owns some vol, right? If the street was short a load of vol and you got a realized move of 3% from a base vol of 21, I think we were at this morning, right? It makes no sense that the street's not trying to cover their short vol positions, right? So there would be a bid to vol, fixed strike vol would be up, VIX would be performing pretty damn well, right? But the fact that we get this type of re-rating, and often you see it, right, when the market is pricing an event move, this was an event, right? Like everyone knew the CPI was today. It was priced, the gamma was trading relatively expensive because it was expecting an event. We got the shock, and you often get that vol reset that comes after the event. Now, like you say, FOMC is still to come. So you won't really get your full vol reset until FOMC is out the way, right?
Yeah.
Maybe that's what we're seeing, right? We're seeing, we were expecting a spot move. Okay, we're back down to 4,000. Enough is enough. That's a 2 sigma move. And now let's wait for FOMC. But the implies don't need to explode because they're already trading expensive, right? So that's why I think now if we do start to break down and say we get below 3,800, so then we're closer to the 36 strike than we are to the 4,000 strike, then I think you start to see a real grab for vol because all the longs that are coming from the 4,005 are getting offset, if not more, taken short by the 36 area strike that they're short, 35.80, whatever. And then I can't see how vol doesn't explode down there, basically. But I think there's going to be this tipping point somewhere sort of between 3,900 and 3,800 where the vol will have to start to accelerate if we were to break that. But until we break 3,900, I don't think vol's going to be particularly bid. That's
yeah. And we have these strikes printed out here, as you can see on the chart. So, we've been looking at, I think vol clearly had, we had sort of jumped the shark here on this chase. And I think a lot of that, I've spoken ad nauseum about this now, that this was all just sort of this put delta that just got crushed, and vol did come down pretty sharply and still had this premium. But one of the things that I've been thinking about here is when you look at the price of options, let's say going into Friday, right? And you had this view that these options positions, right, can drive volatility and possibly push the price distribution in a way that maybe is not priced in, right, by other entities, right? The idea of this sort of reflexive feedback loop based on positioning. Do you ever consider that when you're looking at downside protection? So let's say that, you think, look, if this market really starts to break down more sharply here, the reason that the market, if it breaks 3,900, vol is really going to spike there. Do you think that really gets accounted for, that vol of vol arguably from positioning gets accounted for in a lot of the pricing models? Or is there a little bit of edge, you think, there? Because I think, for example, this morning, I don't know that anybody really was looking at 150 handle move, right, down to this big option strike. And I'm not sure what the straddle was pricing before. I should have looked that up. But I would argue that people are looking at what a 1 sigma move maybe would be, but it's that options positioning, right, that forces a 1 standard deviation move to be a 2 standard deviation move. And I think sometimes you can see this in the positioning where the edge is in saying, look, we're so close to expiration in this case that if we get a delta drop in a vol spike, those options are worth way more, right? Because there's no such thing as a small move here. It's either going to be a giant move up or a giant move down. There's no sort of like calm. You see what I'm getting at?
Yeah, no, I definitely think, if you can identify when there are those sort of positioning kind of pockets, and into expiry, there happens to also be an event like a CPI where you could get a game-changing piece of data which will catalyze certain flows in the market, then yeah, I think there probably is some edge. I mean, I was flagging that on my Vol dashboard that skew had got to the 0 percentile. So like if you look at 25 delta skew on S&P, that I was seeing that at the 20 at the close to 0, like 1 or 0 percentile or something on an 18-month look back. So that had got really quite cheap. But so I was like toying with the idea, and I didn't pull any triggers annoyingly, right? But I was toying with the idea of selling like the 4,000 strike to October and then buying a load of downsides either in October 36, 37 area, or maybe doing it in December in the 34, 35 area. Because if we then break down, I think there's a decent bid to the vol that I'm going to head towards in those downside strikes. But whilst we don't break 4,000 in a meaningful way, I think we're going to get sucked there. We could get sucked there into the end of September. So I like that the structure of that volatility position where you're kind of using the local at the money stuff that you think has got quite a high probability of pinning to fund what looks like quite cheap downside on a relative basis. Right. And if we do start to puke, you move away from the 4,000s and you go to, you've obviously bought multiple quantities of the downside that you go towards, and the Vega grows and hopefully vol catches a bid, right? So those type of put ratio structures, but you can even make it a calendar, as embedded calendar in there as well, if you think the front end is at risk of getting pinned, basically, right? So I thought, yeah, that was something that was on my radar, but annoyingly, I didn't execute it before the CPI.
Hindsight, 2020, right? We always miss the best trades. So, and that also leads to this other interesting point. I mean, this is the skew index, the SDEX we tend to look at rather than the skew index. They're basically the same thing, but this is looking, and again, these things have really been widely talked about at this point where, if you're trying to measure just any kind of tail risk, like, yeah, it's starting to wake up maybe a little bit here, and we'll see how these numbers kind of refresh in tomorrow. But, there's just not much to say here that anybody is really shifting to think that there's going to be a big tail move. And this goes back to the old question: is it because people have already delevered, or vol hasn't paid off this year, or whatever else the other sort of the different thoughts on this are? The fact is that I don't know that anybody knows at this point, outside of major credit issues, what's going to cause people to really start to grab for that real downside protection in a material way.
Yeah. I mean, look, really the thing that's spooking markets generally is when yields spike, right? And yields, where's the 10-year now? We're still at 340 or something. So, next big level, I guess 3.5 in the 10-year. When that breaks, if and when that breaks, market has another little panic, right? So I think, if the 10-year starts to head towards 4%, the market is not going to like it, right? So yeah. I do think things are going to start to snowball a bit if that was to happen.
And do you have a level in mind where you say, look, the yield on the 10-year gets so attractive that we're all just going to have to buy the 10-year and say, screw equities at this point? I mean, because we're talking about in a related sense too. If you're in Europe right now, or basically anywhere else in the world, there's got to be also this just capital flight to the United States, right? I mean, you sit in London, for those of you who don't know, so I think you have an interesting view. And is there, so money coming to the U.S., but then also, what yield do you just sort of like want to start locking in, that 10-year yield versus trying to chase a deteriorating equity yield?
Yeah, I mean, there is that element. In theory, yeah, there should be like a trade-off between, the risk-less asset and the risky asset, right? And people look at the yield and look at the, what do they look at? The equity risk premium, right? So you should be getting a better yield out of equities to make it worthwhile taking that risk, right? So it's the trade-off. And really, people look at real yields versus equities, earnings yields, and they compare those, right? But I just think that the inflation's the issue, right? If inflation is going to be around and it's going to be in these, these astronomical sort of levels for a while, just owning bonds is a scary prospect, right? Because your bonds are just getting eroded away, right? Right. So you want something that gives you some inflation protection, right? Whether equities does or not is debatable, because sometimes equities can have a bit of a disaster in an inflationary regime, and you want to gravitate towards real assets and things like that. But That's the risk on bonds, right? Like if inflation ends up being way higher for way longer, then yeah, you don't really want to be in bonds, right? That's the theory. Now, in this move today, we had the 2-year up something like 16 bips, and the 30-year was only up 4 bips. So it is suggesting that it's not like the back end's going up 10 plus bips, basically. So it is suggesting that maybe we reach a bit of a low in the long end of the curve, and maybe people will be happy buying TLTs and things like that. A lot of people already bought TLTs and got their fingers burnt, though, right? So I don't know. I was surprised the inflation came out so high. I thought it was going to be more in line, given that gasoline rolled over, but core is for core to come out double what was expected was a bit of a shock. Right. Well, we see it. Market. I think the whole market agrees it was a shock. Otherwise, we wouldn't be down 3% on the day. Right. So, I think you need to be quite careful actually of being too long bonds. I can see a reason to start allocating softly into bonds, but God knows, right? When we get guidance from the Fed, and then let's say expectations get revised, and people thinking rates are going to top out at 4, but what if they need to go to 5? Right. What does that do to the long end of the bond market?
Right. And that's of course the what I sort of subscribe to is that idea that inflation just remains 4 or 5% elevated for longer because there's just supply issues that aren't going to be resolved anytime soon, and it's just kind of maybe that's just fodder for a longer term bear market. I mean, it still feels to me overall like there is this idea that we're going to get this bounce back to all time highs. Like everyone's still predisposed to the idea that immediately, the Fed's going to get our back and we're just going to, rip back to all-time highs. And I don't want to miss that move. And you get these rallies that are so violent that you go, oh crap, like here we go. Right. I missed the bottom. And I think that, I wonder how long it takes people's hands to get slapped to realize like, okay, we just got to reprice this lower. And, it's just a function of maybe it just grinds down, right? That's just a bear that none of us have seen in a long time.
But like that mentality about not wanting to miss the rally, the FOMO and stuff, I mean, that's being driven by retail, right? Like discretionary asset managers, people who've been trading for decades are not thinking that way, I don't think, right? Like if anything, they're underweight and they're just like crossing their fingers that it's just a bear market squeeze and they don't need to do anything, right? That's the impression I get, that the old school money managers who've been around and look at the fundamentals, they are all underweight, it seems. Then you've got the retail community that do have that FOMO and want to catch these up waves, right? Because that's all they know, really, buy the dip because it's worked for so long. But I don't know that the whole community is in that FOMO mentality, though, right? I don't, everyone I talk to, anyway, seems to be more bearish than bullish, right? I don't hear people thinking, if I was to turn around and say to people, yeah, well, I think we're going back to the highs by year end, I mean, they'll think I'm mental, right? As in, they'll be shocked, right? So I might be in my own little bearish echo chamber. It's very possible, right? But I don't speak to a lot of people who are bullish, to be honest.
I mean, we on you had your roundtable a couple of weeks back now, and everyone on that call thought that the low has not been in for the market. So, I definitely fall into that camp. Goldman had a chart out this week, and there's been a few others about call positioning, really picking up. And they had mentioned that they thought that the pain trade was more upside here, and you kind of just get this, chase, right? And that's not the same as clearly, fundamental buyers trying to flood into the market. But at the same time, you see the fact that there are not a lot of people looking. But again, bears have had a shot, right? We almost broke 3,900, market held up. How many times this year have we all been sitting there saying, this is the move, finally, the puke, and it just doesn't really materialize. And for different reasons. I don't know that the retail market is strong enough to hold all that up. Maybe it's simply a reflection of CTA positioning and the like.
Yeah, 100%. I'm not saying retail are the only buyers, because the systematic community are buyers for sure, right?
Yeah.
But the systematic community keeps getting top and tailed. So what happens is you get everyone too bearish, then you get a bit of a relief rally that turns into a bit of a short squeeze that then forces CTAs and those types in because the momentum indicators all switch back the other way and they start forcing it higher, right? But then you get financial conditions easing too much that the Fed says, whoa, 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 what the hell? I've just hiked 200 basis points and nothing's changed. You guys need to stop this, right? So it feels like we're in this really big trading range, right, of 3,800 to like 4,300, right? That seems to me like that's what we're in on the S&P, and it's going to take quite a lot in either direction to break out of that. So on the upside, it's going to take inflation rolls over and growth doesn't. So we suddenly find ourselves in the best case Goldilocks scenario, and we go through 4,400 and away we go, which I think is very low probability, right? And then you have the downside scenario, like what's going to make us really crack 3,800 when the whole world has been ready and bearish and set up and hedged. What, how bad does the news have to get to break that? That I don't know the answer to, because obviously we've had so many attempts to the downside, and the resilience that it shows is quite impressive, right? So I don't know what it's going to take to crack the downside. No.
The other thing that's so fascinating to me is that Europe seems to be sort of offering more stimulus, right, with the unfortunate energy situation there and the like. And I think you see a lot of that in the United States, honestly. I mean, I heard a fella here say that something like 40,000 homes here in Connecticut, where I live, can't afford their utility bill. There's a guy in the energy complex. So I haven't fact checked that for the record. But the point is that people here are thinking more pain, right? And the government wants to meet that with stimulus. And so I think there's this weird situation now where we're going to meet sort of the pain of inflation with stimulus. And then my mind starts to spin into the vortex of what, the implications of that are.
It just sounds so nuts. It's like, on the one hand, you're trying to bring inflation down, and then you're providing stimulus, which is the complete opposite, right?
Yeah.
So how do you expect to get inflation down, right?
Yeah, and I don't really know that answer. So, look, here's the question I'd like to move to. What is the signal for you to say, look, I don't know if let's just say your 401k is all in cash. I don't even know if you have 401ks there in London, but let's just say you're all in cash.
The equivalent, is my. I know what you mean.
What is the signal for you to go, okay, look, time to get back in. We got a nice discount on equities. I was fortunate to be in cash. This is my bat signal to get back into the market. Longer term, I'm talking holding for 6 months or something like that.
Good question. I mean, look, I'm happy to miss the first 10 or 15%.
Yeah.
Right. That's the point. Like, I don't, because if it really is going to go higher, it can go a shit ton higher. Right. So you don't need, like, when we're in this environment, when the risk is so high and just the state of the world is a bit of a mess. Right. And we haven't seen these sort of conditions before. And governments are like, governments are trying to address the issues, but they're not necessarily the smartest cookies, right? Like, they're not all, some of the actions that governments have taken with regards to ESG policy and stuff have created these inflation problems, right? And these bottlenecks within the energy space. So I don't know. I mean, I just don't see the point in like putting too much risk on in the long-term money that you don't want to see evaporate. It's not to say I'm 100% in cash. I mean, I'm probably 20% cash right now or something. But I have got I've got a healthy allocation to commodities, which actually makes me sleep a lot easier at night, to be honest. Right. So I'm a bit more balanced between equities, bit of bonds and commodities. I'm probably kind of quite well balanced between equities and commodities in the long-term portfolio. And like I said, I think that you have to have in this environment, you have to have some real assets in your portfolio. And if you look back at the 70s and you look at what performed in that environment, which is as close to the environment that we're in now as there has been historically, then you had to have some real assets in your portfolio, basically. So that's why I've got it. And also the fact that the fundamentals, the fact that the tightness in those various energy markets, obviously they've had a bit of a pullback recently, right? But the outlook for food, for example, with what's going on in fertilizer, which is on the back of what's going on in gas markets, and it is quite scary, right? So I think you kind of do need to have a basket of commodities in your 401ks if you can, that are, a non-negligible allocation in this environment.
Yeah. And this is the agriculture fund, which I don't know if it's the best one. It's just the one I know off the top of my head here. agriculture ETF. We've talked about the MOVE index, and I think people are tired of hearing about that, but that is sort of the one for me that I am really paying attention to. But the other thing that has been so interesting to me is, and I wanted to get your feedback on it, it's the realized volatility, right? And give me one quick second here. I'll bring this chart up. This on your screen here is the E-mini liquidity, right? And you can see right here how it just evaporated, right? Late last year. This is around the September timeframe. This is right when the Fed started to say, look, we're going to have to consider raising rates, and they kind of started to hint a little more stronger as we went along, right? That they were going to raise it, and this liquidity just evaporated. And you think about a move today where you just drop, whatever it is, 150 handles in 60 or 100 handles in 60 seconds, and you realize that the jump risk here in the market, right, is going to remain, right? The instability of the market is going to remain. And I don't fully understand why this liquidity seemed to just vanish, right? And I think what the relation is, and where I'm going with this is that if you look at realized vol, right? This is the S&P Global. You can pull this up. This is the S&P Global 1 month volatility, and you can see here. I've posted this chart a few times now. We're at a sustained level above 20. And I think as long as liquidity looks like this, right, then the sustained level is going to be above 20. But that sustained level above 20 is greater than any point in the last, as you can see on this chart, certainly in the last 10 years. You probably have to go back to the financial crisis, right, to have a similar situation. And that's a chart that I've been meaning to build sort of ourselves here. And yeah, you get these bursts, right, with the COVID crash and Volmageddon or whatever. But this is a sustained level that started to really pick up late last year, and so highly correlated to this chart.
No, so it makes sense, right, that less liquidity means bigger swings, right? For the same amount of volume needing to transact, it's going to mean that you have more market impact. So that should be relatively intuitive, right? Well, I forgot. I had something really smart that I was going to say, and then I've forgotten what it was.
I'll come back to
it. But oh, damn it!
So I think if you have a healthy market, right, and I don't know if this is I don't know if this was some kind of funding exercise, where capital is just more expensive and margin gets reduced, and that results in the chain reaction of liquidity being withdrawn. Those types of different things, right? But again, with that liquidity sort of evaporating, it just harkens back to the instability in the market, which is shown in realized vol. And I don't think any of that settles down until, again, that bond volatility drops, right? Until we have some sort of view on where interest rates are going to settle. We may not get that for some time, right?
I remember what I was going to say now. And it's, kind of echoing that point, basically, which is economic volatility is as high as I can remember it, right? So, last month's inflation data was just ridiculously surprising to the downside, right? Like it was a huge fall off in inflation, and that's why everyone was celebrating it, and it triggered a market rally. And then you had today inflation data coming double what was expected, right? So we're just getting so much volatility in economic data since COVID, really, right? And that's why this realized volatility can't go away, because when you've got that much uncertainty and noise in your economic data and forecasts are so wrong, then you're going to get more volatility in markets, basically. Yeah.
And a couple of people here in the chat mentioning too, QT's coming in. There's a great article in Wall Street Journal with the Fed guy, Joseph Wang, and saying, QT is going to be more pain for markets, and apparently Imran is looking at 100 basis point increase now. So to your point of uncertainty, there's a lot of things that are clearly changing here that I don't know we've all sort of really traded through. At least there's probably a lot of people who weren't around in 2006 and 7, that don't understand that environment, quite the same. And Zork brings up, we're trading data point to data point. The the event vol tied to the CPI is almost like an FOMC date now, right? It's like he brings up a good point. Like now the jobs number is going to get this huge, volatility number. Whereas before, like the jobs number come out and everyone sort of chat about it for 5 minutes and we'd really just kind of move on. But now these data points are just causing really chaos.
I say inflation has become more important than the jobs data because that is the mandate.
Yes, for sure.
Is they care much more about bringing inflation in check than they do about protecting jobs and protecting growth. Basically, they've kind of said that, right? So they said we have to be willing to take some pain to get inflation in check, and if we don't, then it just means more pain ahead. So that's our main priority. So that's why the inflation data has become the most market moving data, as we've just seen, right? But yeah, that's right. Data point to data point, exactly right. And when the data points are significantly different from expectations, you get these vacuum type moves on the fact that liquidity, the depth of book just isn't there to take a decent amount of volume, right?
Yeah. So I want to shift, quickly again to the Fed, and the interesting thing that's on the Fed here, you see the markets kind of starting to slide lower, is that we have next week a kind of an interesting series of events, right? We have FOMC on the 21st, and then we also have VIX expiration, right, on the 21st, which is the same day. Sorry, I'm not very adept at moving my chart around here. And so that's an interesting overlay of events. In these markets that have been more volatile, we've seen several times that the VIX expirations had these big VIX puts, right, tied to them, and we'll get this unusual jump in markets the day before into expiration, right? And now sort of, do you see an impact or the fact that the FOMC is laying on the same day or falling on the same day as VIX expiration? Do you see sort of any potential impact there with those two things falling on the same day, or kind of a non-event?
Well, you would think that if there's going to be an event premium attached to the FOMC, you would think that it's going to be hard for the VIX to have a low print on that morning when the FOMC is in that evening, basically, right? So like when I've seen in the past, when that's happened, when it's been like a key date, like an FOMC on the same day as the VIX, the trade that I've done historically is I've tried to sell puts on the VIX because I think it's flawed. I don't think it's going to crash down, and I use that premium to buy, because the VIX puts are on the Wednesday expiry, and then I've bought the Friday expiry, or either the same week Friday or the next Friday. I bought VXX puts with the premium, basically, right? What you're saying is they're not going to let VIX get crushed before the FOMC, but post the FOMC, VIX has got room to get crushed, and I can put on what is as close to zero premium trade to get into that view that vol's going to get crushed post event, basically. So I have done that historically with a little bit of success, but obviously it can always go wrong. But yeah, that would be how I would think about playing it if that was the view that the event vol is going to hold the VIX up, basically, for that.
Right. Yeah. And then playing into the end of the month here, obviously everyone keeps asking about this JP Morgan trade, and I think that it's still a little too early until you get closer to, 2 weeks from now feels like it feels, years away, right? It's a lifetime in terms of what could happen in the market. And I've sort of been of the opinion that those strikes don't matter that much because it's sort of blended with the 4,000. But, if we trade into and around one of those strikes, it can have more of an impact. So, I think the interesting thing here is that if you look back at this chart and look at where these quarterly OPEXs sort of fall, they seem to function right as this turning point because there's this sort of big trade. So I think that as we get through FOMC and we see the direction of FOMC, you can start to maybe, wager a little more in terms of what that end of quarter sort of positioning will have an effect. But from my view, it's just a little bit too early right now to have a real feeling on the impact.
You showed where you had the big open interest in calls that was offset by the open interest on that 4,000 strike. But does that, is there a mismatch on the expiries there? For example, we know
this shows all expirations.
Yeah, but so if you were to take away this Friday's, would the put number go down dramatically, but the call number would stay because it's 30th of September? Do you
Yeah,
know?
I have some of that data I could actually run right now. It's a very good point. And you know, if we just flip to looking at the spiders, for example, which has been, you know, arguably even a larger complex right now than the S&P, you get a very similar, you know, layout here in that there are these big positions at 4,000, and then when you start to drift below that, there's not, you know, a whole lot of puts down in this area, right? And so, how do you adjust to that dynamic of new positions coming on, right, with vol coming up and those deltas coming off? And then if you believe that JP Morgan is, you know, that dealers are long that strike and selling futures against it, then why shouldn't it help to push the market lower, right, if we do start to drift down?
Well, no, I mean, I don't think that would happen just because if let's assume that right now the position is quite balanced, right? So let's say
Mm-hmm.
that number is a gamma number, right? The y-axis is gamma, I guess. Is that right?
Yep.
Yeah. And the x-axis
Yep.
is strike. So let's, for
Yep.
argument's sake, let's assume right now that's quite balanced. So what we're saying is round here, the dealer's net gamma isn't that enormous, okay? But if, let's say, the short gamma is coming from short puts that goes away this Friday, and the long gamma is coming primarily from the long 4005 strike, let's say, right? Then that's the leg that's below the x-axis is going to go away. They're going to be left long gamma, and then if the market does go down, well, obviously they're long gamma, right? So they're going to get shorter deltas, and they're going to be a buyer down there at like 3,900 or whatever, right? So it should be more supportive to the market after this Friday than it is currently. If that is a wall of support, that 4005 strike, it doesn't look like it's been much support today, but that's good. I think the short puts that are for this Friday are overwhelming it right now, and once that evaporates, if there's not enough new purchases of gamma from the buy side, then dealers are going to be now long that 4005 strike, and in theory that should then act as a support to the market, right? Because that long gamma is going to then try and gravitate the market back towards that strike. That's what I would think, right?
Yeah. So this is the open interest for Friday's expiration, calls on the top here and puts on the bottom. So, you know, again, a lot of this is labeled at the 4,000 area. And this landscape is obviously going to change a lot into tomorrow as we get the open interest in refresh. But that positioning that you mentioned, I have to, you know, generally, you know, agree with that. And I do think it, you know, where that position gets much more interesting from my perspective is if we do trade down. I mean, that's quite a move, right? To get down around 3,600 by the end of the month. But that, to me, is where things get a little more interesting with that JP Morgan position.
Yeah, well, that's when the street, then we conclusively would say the street is very short down there, right?
Yeah,
Agree?
right. And that could potentially soften the blow. Much like we were talking about, I guess it was in June expiration, right? This idea that they can supply more because we know that they're long that lower strike put, like they're long this area, which is currently not worth a whole lot, particularly as we get, you know, closer to.
What is that? That's like 3,000 though, that area, right?
Right, 30-20. So that really is quite a bit down from here.
Yeah.
And then, you know, Todd here mentions Hero, which I did want to mention. There's some interesting flow here, just looking at the intraday flow. To your point at the top, there hasn't been this volatility grab, right? And what was interesting looking at the way the deltas were trading before, there's the big block print, so we kind of want to ignore that one at the moment. But if we kind of just zoom out, what we saw in the initial test at 300, and even in the S&P was the same thing, was people monetized their put position is really what this delta rally is here, right? And so I think anyone who was long puts or short calls, right, the market tanked and then they close those positions and we get this sort of delta cover, right? And that buoyed markets a little bit, but I think we're starting to, you know, you could see here when this purple line trades lower, that is traders buying puts or selling calls, and that starts to pressure the market back lower again. And in the spider, it's really the same thing. You got this sort of rally, right, as we approached 400 or broke under 400, and now you can see that the positioning is really turning over. People mentioned some China headlines and some things like that, but now what we're really getting, if I blow this chart up here, you can see what we're really getting is demand for buying puts in particular, this blue line going down, you can see it's kind of accelerating here. That blue line going lower is telling us that people are looking to buy put protection. And so, I think that first bounce made a lot of sense in this context, right? You're gonna close some positions if you feel like you were lucky and had a bunch of puts in that CPI print. You're gonna monetize that, right?
For sure.
And now people are starting to sort of regress. And to both of our sort of points before, those puts that expire on Friday are all still there. Those things can energize, and if people see the need to suddenly go long vol, this is my argument with the issue with tail decks and some of the skew metrics you were mentioning before, that no one's really long that stuff, and you can argue that people are probably short some of that stuff. And if they are forced to cover, that buying has the same impact as people who are just initially buying, right? So all this, buying those puts all works the same way if there's suddenly a grab. So that can really add to a lot of the jump risk, which is what some of my concern is here.
Yeah, no, like I said before, I think the more we get away from that 4,000 strike, you could have a bit of an acceleration to the downside. I think that's the only thing that's keeping the market from really melting. I mean, it's a pretty big down day already today, right? More, was it 4.6% on the Q? Someone said, right? So yeah, another sort of 3-4% away from this area, and then you've got the potential for all hell to break loose, I think, right? And you could then your VIX 40. We didn't see the spike up to 40 on the VIX that we thought we were going to get like last time around in the June sell-off, right? So I think I think that's what we're looking at. If we get below 3,800 and start targeting 36 again, and that happens towards the end of the month where the street is short that strike to JP, then that's where you could get your VIX 40 plus type spike, basically.
I do tend to agree with you on that. I think that I think a lot of people are taking off sides here and feel like a little bit off sides. And so this is the kind of sneaky move, I think, where particularly with that shift in yields as well, right? That could really change that dynamic here and maybe finally put that VIX 40 number behind us. I mean, still the intraday high on the VIX, I believe, goes back to January. I mean, this is that weird candle, right? This is the day after that big January expiration. And then you get the Russia invasion of Ukraine, right? That was just in this intraday mark right here. So despite the fact that the market went materially lower after both of those dates, the VIX has really not been too responsive. And if you look at volley, this shows the at the money S&P options versus sort of the whole. So take skew out basically, right? S&P skew is basically just at the money S&P options. You can see here it seems like it's staging at a different level, and I think that potential maybe spike is feels like it's maybe a little closer, right? In a way that it wasn't before.
That chart, sorry, that's what VOLI. That's
VOLI, right? Yeah.
That's the floating at the money S&P vol, basically.
That's exactly right. So the VIX measures the entire range of S&P options, right? And volley just looks at the money. So the argument here is you're taking S&P skew out of it and just looking at the money. So if you were going to look at a pure sort of move index, right, which is the at the money options in the treasury market, if you look at volley, that's sort of the more apples to apples equity to treasury vol comparison here.
I haven't seen that volley one before. And then if you did VIX divided by volley, then you would basically get a pure measure of convexity, right?
That's exactly right. Or VIX minus, some people do. So yeah, you get that
VIX over volley. Okay, that's interesting.
Right.
Yeah.
So those are kind of interesting metrics to look at for sure. And so a lot of moving parts here. So we're coming up at the top of the hour, Imran. A couple of days here. What if anything? How are you playing this? What are your sort of thoughts? Are you sort of?
I'm pretty
out through the Fed.
I kind of was quite balanced going into CPI. I didn't have a lot on in equities. I've got some hedges, not a lot, but I've still got some October puts that I've had on for a while. 3,600 in October, just in case. But outside of that, don't have a lot on. Had a bit of FX positioning. Had some euro dollar puts and some dollar yen calls out to December and January. Last week sold some sterling puts against that in the short dates in the 1 month, just to bring some premium back in and kind of offset that risk a little bit, because I just didn't want to be too exposed going into CPI and FOMC.
Yeah.
wait for the market to get stretched one way or another, and then if I want to fade it. So my kind of playbook was to try and fade equities if they went above 4,200 into FOMC. But annoyingly, that didn't happen, right? So I missed that opportunity. So I guess now we're looking at the downside. It's always it's a harder trade to fade the downside move, I think, at the moment, given the macro backdrop. So even if we approach 3,800, I'm not sure I'm going to be that up for fading it. But you can fade it a bit more safely by doing call spreads, call ratio type structures that are relatively low premium to try and play a bounce. Because when we go down there, VIX will be in the high 20s or whatever. And if you think there's a bounce coming, you can kind of benefit from that spot up, vol down dynamic. So I might look at that if and when we get down there to try and get some bullish exposure. But at the moment, I'm playing it pretty safe. I'm not overly positioned one way or another, to be honest.
And from my perspective, I think the more we pull down into OPEX on Friday, the more sort of bounce we could get, right? Just as a knee-jerk reaction off of that. And so, I don't know there's a whole lot of value here, or I don't see a whole lot of edge here, knowing that we could just keep winding down. The one thing I will say is that if you look back at March options expiration, there was a very similar setup here, right? These are the candles right here that I'm talking about, and that we had this big rally, and this is the week of FOMC. FOMC fell 2 days before OPEX back in March. We had a big rally, and then we had this sort of like crash on Monday and Tuesday. That's what these two red bars are. And then we had some China stimulus, and then the Fed gave us this kicker. And then all of a sudden, then we really ripped, like we regained that energy to sort of bounce. And that's kind of the setup that I'm looking at right now. I mean, today's, only Tuesday. So a couple more days of downdraft. Suddenly those put deltas really grow that are going to be expiring. And maybe the Fed only does their 75 bips and doesn't give anyone to anything, for anyone to really hem and haw about, and we could end up with a similar kind of just crazy rally again, right? But all of these things are moves to be traded, right? I think you and I are both in the same view that there's not much for longer term investing at this moment, by and large. So it's positioning around, shorter moves around how positions are changing. So just from food for thought for those trading this week, that the analogy here to that March move is really pretty interesting.
Mm-hmm. Yeah, and then you mentioned on the longer term side, if we started to get below 3,500 on the S&P, and it felt that we were getting close to the end of the hiking cycle and stuff like that, then maybe you start to nibble, right, and start to dip your toes into some equity allocation where you've kept some dry powder in cash, and you can start having a nibble at equities again, right? And
if you look. And that 35 number you mentioned, you start to get back into that February 20 high. And I think a lot of people will be looking to get in around that area, sort of just kind of unwind all the stimulus basically from COVID, and get back to that point is kind of the interesting, I think, thought. But, granted, that's good. That's a ways down from here, right?
Yeah, exactly. Yeah. Someone asking about the VIX versus volley. So all I meant there was that the VIX represents variance swaps, which is the entire strip, right? It's all of the strikes, whereas the volley just represents the at-the-money strike. And so by looking at the ratio of the two, what you're essentially doing is any kind of convexity that the surface has above the at-the-monies gets priced into the VIX level. So if you do the VIX level divided by the volley level, then it should always trade at a premium. That should always be a positive ratio, right? And the extent to that, how rich or cheap that ratio is, gives you a sense of how rich or cheap convexity is, right? By convexity, you can just think of it as wings, the wings of the distribution. You can think of that as convexity, right? So at the moment, convexity is priced quite cheaply, I think, because VIX over volley is quite tight, isn't it, Brent?
It is. I mean, this is a longer view of that, right? And this sort of sinks in the way if you look at VVIX and skew index in a way. These charts all say the same thing. We have a risk reversal metric. We look at the 25 delta put versus the call, and all these things all say the same thing, right? There's not this demand for people don't care about owning vol really. It's just sort of. And arguably, if you wanted to be short, you want to have deltas on and not really, you're not playing for convexity. Convexity has not paid off this year, I guess is really.
Yeah, but you know what normally happens, though, it doesn't work, so no one believes in it, and then it works like amazingly, right?
And that's kind of the point. It's also the fact that no one thinks it's working, is arguably short it, that makes it work better. I think that's
yeah,
the kind
but
of
it's
thing, right?
just very hard to call when that happens, right? That's the problem.
And it can be very expensive waiting for this, when that happens. So.
Yeah, but that's why, I think those type of structures where you sell the 4,000, obviously the market's sold off now, but when we were up there at 41.50, selling the 4,000 area to then buy a load of 36, 37 area and doing it in a ratio where you're not net spending premium in a world where skew's quite flat, kind of gives you access to that crash without having to be too committal to that crash, right? And be like, I just want to be short a load of deltas, and then the market rips 200 points in your face and you get hurt. If you do it that way, where you like, your position can grow as it's working, you got to manage it though. Like if you get slow grind down in that scenario, that can bury you as well, right? There's always a scenario where options can kill you. It's just the way it works, right?
And the worst thing about the slow grind too is you feel correct, right? But your position just is not making any money. Those are the worst.
Which is a horrible feeling. Being right and making no money is worse than being wrong and losing.
100%.
No doubt. And it's happened to us many, many times.
I'm long this complex option structure, strip of blah, blah, blah. I should have just shorted spiders and gone to bed. So, Imran, we're coming up on the top of the hour here. That was a fast hour. Can you please let people know?
Always.
What's that?
It's always fast talking to you, man. Time flies.
It is. A lot of hot air coming out of here. Can you please let people know how to get a hold of you? You are at Options Insight on Twitter.
Options_insight, yeah.
And it should be said, you are the face of the SpotGamma Academy. You have a course that you provide to banks over there in London. And so we said, look, provide that course for everybody at academy.spotgamma.com. It's a fantastic course. We get amazing feedback on that. And what else do you have for the people?
Yeah, so you can check out what we do at options-insight.com. We also sort of offer weekly sort of calls where we go through the main macro drivers, what's going on in the market, and just kind of we're building a trading community of people who want to learn how to use options, utilize options to either risk manage their portfolios or enhance their yields by doing more systematic vol selling stuff, but hopefully a bit safer vol selling, nothing too crazy where they can blow themselves up. So, just kind of people are utilizing my 20 years of experience to kind of help navigate these markets and sort of dip their toes into options trading and hopefully not blow themselves up, right? So I'm there to kind of give them that sense check that they're not doing anything crazy. How can they implement their views and their ideas in the optimized way in options based on what I'm seeing? Yeah.
Nice. And we are at spotgamma.com. You can get a free 7-day trial of our daily note that we write, our hero indicator, which is live deltas, and then also some equity analysis. So please check that out over at spotgamma.com. And I guess, Imran, we may see you before for some odd reason, if we feel like it, but at minimum, we will see you in 30 days.
For sure. All right, man. Nice one. Take care. Thanks for listening, guys.